thank you all very much for coming and joining Yvonne and me. This is obviously a very important topic right now, how to handle this downturn. And thank you, Yvonne, yourself for joining for this. Probably the most important place to start is to make sure your mic is working.
Choose the right one. Same with private equity,
There
by the
we
way.
go. But the best place to start probably is the start. How did we get to this place where this was once a cottage industry is now a behemoth where we can worry about a downturn?
Good morning, everyone. It's amazing how the industry has grown if we look at the last 3 decades, particularly the last one. Essentially, it's an industry that today is about $5 trillion. 30 years ago, the annual amount of private equity raised annually was about $10–20 billion. And today, fundraising, when you look at the last 5 years, was an average of $500–600 billion. So there really are very few industries that have grown as much as the private equity industry. And particularly since the GFC. I think what we've seen post-GFC has been the democratization of private equity. So it's not just a few large pension funds and sovereign wealth funds, but it's really many participants, including increasingly wealth management and retail.
So it led to an industry that obviously was extremely popular. Lots of money got poured behind it. And that's where we find ourselves now, right? A lot of dry powder, but a lot of concerns and perhaps less deals out there. Just in terms of its size, is there some element that private equity grew too much, too fast? Was some of that growth perhaps unhealthy?
That's a very good point. There are a lot of things that private equity has done extremely well, and one is providing superior returns. So we have a history of private equity going through cycles, providing 30 years of superior returns. But there are a few clouds, actually, that we look at. And we've done some analysis looking back 20 years. So essentially, we look from 99–2000 onward. And what we see is from 99 to 2015, the amount of capital deployed is exactly the same as the capital deployed in the last 5 years. The only difference is what you've seen in the last 5 years, the amount of capital that's been invested has been invested in periods of plenty of liquidity, low cost of capital, high valuations, good environment. COVID, it's kind of a blip in a way, but there's been massive intervention from central banks and that's provided an incredible amount of liquidity that's fed in the marketplace. When we look at the investments done in the last 5 years, our estimates about 10% has been realized. And so when you look at the returns on the 99–2015 period, that's about 95% realized, and the returns are good. But there are a few things to look at. If you look at pre-GFC investments, they have not done as well. On a multiple basis, it's respectable, but because they were done at high valuations, hitting the GFC and then the slow recovery after that, it led to fairly low internal rates of returns.
So when those portfolios, you're saying a lot of them are unrealized, when they become realized, what will be the hit to NAVs? What does that look like?
So that's a big question. So you've got massive amounts of capital deployed in the last 5 years. On all metrics, there have been record years, record fundraising years, record deployment years. And at the moment, like I said, about 10% realized. And so when we look at those numbers, actually those portfolios have been marked up because we've had an incredible market second half of 2020, 2021. Obviously, 22 was a different story, but the valuations we ended 2021 with are pretty much the valuations we have at the moment. Private equity has not adjusted. There are many reasons for that. One can be quite cynical, is that many of the funds raised 3 years ago have been put to work in 2 years rather than 4. And if you're a general partner and you have to refill your with a new fund, you can go to your LPs and say, well, look, we invested in 2021 and today, mark to market, it's worth 75 cents. That's not going to help you fundraising. So we have what we call sticky NAVs at the moment.
But it's almost this bind, right? Because you don't want to sell and realize that loss. And at the same time, you don't want to be buying right now because you assume the market has gone down, so you're not willing to pay the same valuations that you were perhaps, at the very end of 2020 and 2021. So how does that equilibrium break then?
Well, actually, there is no equilibrium at the moment, so that's why 2022, very little happened in the marketplace. So if you're a seller, if you bought, you need to sell at 2-3 times your cost. There's an interesting dynamic, and I'll come back directly on your question. If you look at private equity funds, if you look at the last 20 years of data, if you look at funds, they're all essentially constructed the same way in the end. General partners will tell you, we price at 2 to 3 times, and we targeted 20-25% returns. When you look at the reality of things, is the returns on individual investments, if you were to graph them, they're a little bit all over the place. And you have 3 categories of investments done in a fund. You have the few winners, those investments that will return 3 times or more. You have what we call the middle pack, investments between 1 and 3 times cost. And then you have the losers. There are investments that go bad. Things were not going as expected, mistakes by management, paid too much, a variety of reasons. And that loss ratio varies over time. It varies between 20 and 30% with very low recovery rate. Then the middle pack, it's about 50 to 60% of investments. And the winners, it's 20 to 30% depending on where you are in the cycle. And so when you're looking to sell, if you're a GP, you're going to sell your winners. You're going to sell your best assets. I mean, this is what sells. The only thing that sells in today's markets are the great companies that are doing very well, that can go through cycles. They're expensive. And the question for general partners today is, things they bought last year, 2 years, 3, 4 years ago, in the environment we're in, can they get the multiple on those very good assets? Because they will be losers. And one can estimate, are we going to go back to, we entered 2022 with the lowest loss ratio in history, and including mark to market. It was about 10%. That's going to go up to 20, 30%. If we look at 05, 06 investments, only 1 out of 3 made money on the exits.
Does that mean if you're trying to target a 20 to 25% IRR, that's unrealistic in this environment?
I think it's going to be tough. Anything you bought in 2020, 2021, when the cost of capital was very low, you had plenty of debt available. It was very cheap. There was a lot of competition, a lot of liquidity. You need to work into those valuations again. And so if you're a seller, you're looking back at what those businesses were worth 2, 3 years ago. If you're a buyer, it's a lot more expensive today, if you can get the financing. Nothing happened really in 2022. We've all seen distributions come down at least 50% because you cannot get financing. Plus, if you're a buyer, you want to buy based on today's market valuations. Right. And they're not what they were in 2020 and 2021.
How does the calculation of deal making change when financing is so hard to come by? Is it you wait this period out if you can afford to? Or does something change? Does something change about how companies are bought, the things that are bought, if all of a sudden that leverage financing is so much harder to come by?
Deals get done. They're very equitized. So we see deals. The best companies, they still sell for high multiples. It's a lot of equity going in. There's still a lot of dry powder. And for the debt, increasingly private equity firms go to private debt providers.
Right.
And it's expensive. And the key question is, when does the financing market come back? It hasn't yet. That's a big question for 2023.
What do you think the recipe is to have it come back? What would the environment be like? Well,
first, the banks still need to clear out about $40 billion of syndicated loans that are sitting on the books on which they're taking losses. You see what's happening with some of those banks. The earnings that came out were not very good. So they need to clear the book, and you need confidence to come back.
So what is that, just the economic environment overall?
Well, it's economic environment, is what the Feds are going to do. It's where inflation is at. It's many factors, and yeah, confidence. You've seen improvements in the market in the last 3 months. because after a lot of bad news, there's been some good news. No more zero COVID in China, and it's not as cold as expected, so maybe we don't have an energy crisis, although when you go outside here, it doesn't feel that warm.
It's very true.
Inflation starting to come down. I heard the economist speaking earlier. I think it's going to be tough. It's going to take a while to get back to 2.5.
So what's the playbook in the meantime?
Well, playbook is manage your assets. One of the statistics or one of the results from the survey is 2023 a good year to invest. My point is it's not just 1 year where it's good to invest. First, in the last 30 years, I've never heard a single GP tell me now is not a good time to invest. It's always a good time to invest. So don't worry about that. It's not just 2023, it's going to be forward. And if you look at actually statistics, it's really the 3-5 years following a market downturn crisis that are good. So the next 3-5 vintages are going to be good to invest. And for the GPs that have a dry powder, first they need to work out the existing portfolio. If in the last 5 years, GPs have invested as much as in the preceding 15 years combined, there's a lot of unrealized assets. And these assets will need to be exited also over the next 3 to 5 years. And if we have a recession or if we have a tough environment, there's going to be a lot of work on that portfolio. And so the GPs are going to be torn and busy between working, managing the existing portfolio, and there's a lot there. Creating value. I think that's a big challenge for the private equity industry. Justifying the marks and working towards exits, and being active in the market. They can't afford not to be in the market. So it's they have a lot on their plate.
But how difficult though is it to be in the market if it is essentially closed right now?
It's tough. It's challenging. So you need to have. You need to have very good relationship. Well, anyway, the whole community, the whole GP community is going to have a lot of discussion with their banks because maybe not in 2023, but certainly in 2024, there is a wall of refinancing that's coming up, 24, 25. 23 is a critical year. The market needs some stability because with the refinancing of all these unrealized investments done in 20 and 21 coming up, the refinancing is going to create a lot of discussions between the providers of credit and the private equity general partners. The terms are not going to be as good. You're not going to see no covenant, no very loose
the Cov Lights of the world.
Yeah. Oh yeah, that's today. Forget it. It's going to be very tight, and it's not going to cost 4% anymore or 3-4%. It's going to cost today. Senior debt is 10%. So cost of capital overall comes up. It's not rocket science. Right. If your cost of capital or the weighted average cost of capital from a very low base goes up 500 basis points, both on the debt and the equity, valuations come down. Right. Especially if the prospects of slower growth going forward comes in the equation as well.
And just to let everyone know, I'm going to open the questions to all of you, to the audience in just a moment. So if you have any in mind, start thinking of them. But before I do that, so valuations start to come down. What do you expect that to look like?
Well, I'm not sure the valuations will come down. I think, the rationale you heard in 2022 is, look, we bought these companies 2 years ago, 1 year ago. They're doing exactly as expected. And if you look at the numbers in 2022, the companies did as well as expected. Many have been able to pass on inflation. There's been no pressure on margins. That might change in 2023. And so the rationale is we bought them with certain expectations. Those expectations are being met. Therefore, we're not changing the valuation.
Okay.
The question to ask a general partner is, well, if you had to buy that same business today, why would you pay? Because financing is more difficult.
Yes.
Your cost of capital goes up. And there has been, I think it's the only year, one of the few, where there's been no single, 2022, no single IPO for PE-backed company. That's quite exceptional given the size of the market.
Yeah.
There's been a few sales. We see, and we need to distinguish the large mega buyout segment and the small mid market. A lot of what I'm describing is slightly different in the small mid market because, you don't have these very large debt packages put together. The pricing, by definition, is also different.
Does that make that segment more resilient then in this current environment?
It has. We've seen it.
Yeah.
Exactly the same post-GFC. Post-GFC, we've seen the small mid-market being more vibrant, where there are some exits, where there are realizations, because the assets are not bought at the same levels of multiples. You don't have the same levels of leverage. And what's happening, why it continues also to be vibrant here, is if you're a GP, you bought a business 2 years ago, you paid 15 times. If you think today you can only get 12 times EBITDA if you were to sell it, you need growth. You need to create value. What do you do? Well, you can buy some of these smaller businesses from other GPs. They bought them for 5, 6, 7 times. They're happy selling them for 10, 11 times. There's been growth. There is valuation, multiple arbitrage at the smaller end. And the large private equity firms are happy because, well, they can bring down their acquisition multiples. So they go from 15 to 14 to 12. There are some synergies. I think we're going to see quite a bit of that. That's one way for general partners in their portfolios to create value. So we're going to see activity in that segment of the market.
Okay. And with that, let's go ahead and open it up. If any audience members have any questions, Yvonne? If not, I'm happy to keep peppering him. There's one over here. I don't know if anyone is over here. This gentleman.
Thank you. Do you have a preferred asset type for the underlying assets? So, for example, growth versus buyout or early stage VC as you look out for this next 3 to 5 year period? And also in terms of the sectors or the industries when you're thinking about kind of fintech or regtech or retail, whatever?
Well, I think tech in general, I mean, you just have to look at the market to see what's happening. That's a market that's much more volatile than even the buyout market. So we can expect in the growth venture market for the winter to be quite a bit longer, actually. You have a lot of adjustments that need to take place. I mean, money was flowing to VC and tech and growth, just in a way so easily, because the cost of that capital was extremely low. So you need to see the adjustments in that segment, and we're starting to see it. I mean, you can just look at tech companies. They're the ones doing the layoffs. Was Google yesterday that announced? What was it?
Yeah, Google over the weekend. I think about 6% of their workforce.
Yeah, I mean, that's quite significant, huh? I mean, it tells you one thing, that growth is slowing down. That they're not counting on the growth. So they grew tremendously. They were the darlings of Wall Street, of private equity investors. The returns have been just phenomenal. It's part of the cycle. I mean, we've seen it before. And it will take, I would say, probably a few years to adjust. Again, at some point, the market stabilizes and provides a good basis for investors to come back in. But you need to see a lot of, some cleanup will take place. Well, I'm not saying it's my least preferred. I'm saying it's a market that needs to go through its adjustments, where you have liquidity becoming less available and the cost of capital is much higher. It affects techs because your positive cash flow is so far out. Any discounting with a higher cost of capital brings value significantly lower.
Are there any sectors, though, that you think valuations have remained fair that still do look attractive?
I mean, this is what I was telling my team in 2021. It's like everything is so expensive. Yeah. I mean, during ICs, I guess that's the benefit of having gone through cycles. You look at businesses, what they sold for, and sometimes, a deal would come in at 12, and I'm asking the team, it's like, well, if things get difficult, what do you think it's worth? And you've got things that we're selling for 12 times that they're really worth 8 times. Things that, software. Every single buyout firm at some point did a software deal. And so it went from 15 times EBITDA to 20 times EBITDA, 25. We saw some at 30 times EBITDA. At some point, you said stop.
And there did also seem to be this trend of, you'd call something software, you'd call something part of the cloud, even if perhaps it wasn't a cloud company. So it seems like there was some seepage from that as
SaaS,
well.
you know,
Yeah,
it's
exactly.
SaaS, so it's worth a lot more, and SaaS is going to be, 50, 60, 70% of the revenues, therefore it implies a higher multiple. I mean, you can always justify your valuation. At some point, you go back to basics when the market tells you, stop. So it's difficult to predict. I mean, as Mark Twain would say, it's extremely difficult to make predictions, and particularly about the future.
Very poetic.
My question is green transition or sustainable development investment
Yeah.
are going to be the driver as the tech company were in recently. Is it possible, and are the investors ready to do that?
Well, it's more of an emerging segment of the market, right? I mean, you've seen in the US, that's one area. You see some climate fund. The same with impact. I mean, if you think it's private equity with a twist, I call it, because in the end, investors are looking for a return, and so it's to do well and to do good at the same time. It's too early. I mean, I don't think you have enough track record there to say, is this an area of that's going to provide unique and attractive opportunities? I think those types of evolutions of the private equity market, they take time to develop. And so I always say sometimes you don't need to be a pioneer. You don't need to be the first one going into these more targeted strategies. See if all the elements for good private equity returns are there, and maybe it's in a couple of years from now, but certainly an area where you're going to see a lot of investment opportunities.
Any other questions? If I can just pick up on the sort of transition investing theme also, I mean, there's been a lot in the press as of late over the past year about concerns of greenwashing, and part of it is just that we lack definitions and we lack data. Do you think there's still a reckoning to come in the wider industry of what we sort of label as these type of ESG investments?
ESG impact? Yeah, absolutely. I mean, we see, we're active in that market also in impact. And you see big differences between, what we call impact private equity and what some others. The measurement, I think you need to be very clear on what data you need and the ability to measure it and to report it. I think there's a lot of progress to be made. We're working very hard on that. We're doing it. Yeah, it's an area that continues to evolve, definitely, because there is no standard.
Right.
I mean, if you think about even performance measurement in just traditional private equity, you see, that's been the old joke in private equity, 90% of the funds are top quartile because everybody plays out performance measurement the way it advantages them. The same on impact. You don't have a standard, and we're working towards a standard. I think it's important for the LPs to also push the GPs and say, well, I want better reporting, I want better measurement. There's been great progress done in the last few years.
I was gonna say,
there's still a long way to go.
Who is that led by? I mean, is there a point where regulation steps in?
The great thing about private equity is the industry has actually managed itself quite well without regulation. That was one of the points also brought by Antoine in his opening speech, is it's a long-term industry. So it's not an industry that takes short-term cuts. You can take shortcuts. It's really longer term, and by being long-term also in the way it's incentivized, entrepreneurial, it has been able to regulate itself. And I think I take the view that the industry can do that itself. I don't think it needs maybe input, I'm not sure, from regulators, but I think we, as a large LP community, together with the general partner community, can do that. Absolutely.
In sort of looking, only just because we only have a few minutes left, but from here on out, I wonder if the lens at which we view the industry changes. If over the past 5, 10 years, it was, I mean, to say it sort of pejoratively, it was easy. If you had cheap financing, you could kind of buy anything, and as long as you could, pay down that debt with the company's cash flow, you could get a return. If we return to some sort of normal, what does that normal look like?
Yeah, I mean, since GFC, I think it has been as good as it gets for the industry. I think we've had 12, 13 years that have been absolutely fantastic for private equity and private equity investors. The returns have been phenomenal. If you look at funds raised post-GFC, I would say up to investments done between 2009 and 15, 16, the returns have been 2.5 times on average. Some GPs do better. Some do a little bit less. The returns have been 20%. You can be cynical and say, look, all you had to do is, on the backdrop of declining interest rates, rising valuations, good, stable economic growth, low inflation, all you had to do is deploy capital. For the most part, that was true. I think that has changed. And so that's why I'm a little bit worried about those last 5 years of investments, because it's so large. It's going to be really telling on who was disciplined, who invested, and who deployed capital. And I think we'll see that. We'll see that through the loss ratios and how many winners are in each portfolios. And we're going to see, if there's been disparity among managers in the past, I think we're going to see a greater one on investments done the last 5 years. Interesting statistics. When you look at the loss ratios and what I call the middle pack, investments between 1 and 3 times, that's on average 75% of a portfolio. If you look at when those investments are realized, it returns capital. So the winners is what drives performance. So is it 20%? So if you look at funds invested pre-crisis, usually, it's 1 out of 5 investments on average. Funds invested post financial crisis or difficult periods, it rises to about 30%. And that's the difference between private equity returning 2.5, 3 times or just 2 times. And if you look at the 05, 06 funds, on average, net growth, they did about 2 times, net 1.5, 1.6, but it took so long. The IRRs were single digits, 6, 7%. And so, the last 5 years of unrealized values, there's tremendous demand for liquidity coming up on those.
Right. Well, I'm afraid we're going to have to leave it there. Yvonne, thank you so much.
Thank
Please,
you,
everyone,
Danny.
join me thanking Yvonne for that. It was fantastic.